Welcome to Gagliardi's Got Real Estate Podcast, hosted by myself, Gerald, Sabri, and Rocky Gagliardi. We look forward to bringing you something fresh, something new the Golden Valley hasn't seen before, more informative information. We've got special guests, hot topics. Make sure you follow on your preferred podcast platform, GSRE Socials. We hope you enjoy this episode. G'day viewers, my name's Gerald Sabri and welcome to episode 6 of GSRE Podcast, and today we've got two local guests with us, Matt Jones from Jones and Mitchell Legal and Ric Sofra from Sofra Solicitors, both local here in Shepparton. So welcome guys, thanks for joining us on our podcast. We look forward to a nice interview this morning, and we'll start with yourself, Matt, and just let us know a little bit about yourself and how long you've been in business.
So I've been a practicing solicitor now since 2013, I think, and Jones and Mitchell Legal came into existence in 2019. I'm one of the partners there with my business partner Loretta Mitchell.
Yep.
And I practice mainly in commercial, so all things businesses, leasing, property, wills, yep, you name it. It's a pretty broad spectrum. So I've been had my own business with Loretta since 2019. So,
yep.
But local born and bred. Did my time like most lawyers in Melbourne, and came home, practiced in some other firms, and then Jones and Mitchell Legal in 2019. So, yeah.
Very good. And Ric, welcome, Ric. Just tell us a little bit about yourself.
Great to be here, Jared. Similar story to Matt, a local boy, born and bred. Went away, saw the world a bit, practiced law in Dublin for a few years in a commercial litigation firm. Came back home and went into the family business. Dad, Tony Sofra, has been a local practitioner for 50, 60, 70, 80 years. Every time I speak to him, it goes up by a decade. And I've been in the game for about 25 years. My areas are primarily similar to Matt, commercial, property type transactions.
Yep.
It's probably half of my business, and the other half would be commercial litigation. I do a lot in that space, so I think the litigation experience gained overseas has been able to translate here quite well, and I have a pretty active practice there as well. So we're a busy firm, not dissimilar to Matt. We're all pretty busy at the moment, Matty.
Absolutely.
So in terms of that, we're
Very good. Very good. Well, our main topic today is about business and what's involved in listing and selling of business. And these two guys will give us a great insight in what's involved, how to prepare, and what's happening in that space at the moment. So I'll start with yourself, Ric. What are the main documents required for an owner to provide, when selling a business?
Before I get to that, Jared, it's a big topic you've picked. And I just want to probably say two general bird's eye view comments, if I could.
Yeah.
And Matt will probably support me on this because we've done a lot of transactions together. I think the first thing to say about business is that no two business transactions are the same.
Yep.
There's a lot of moving parts to the transaction. And I've never seen an area of the law which requires so much interaction between lawyers, accountants, real estate agents, and the parties themselves.
Yeah.
The second thing I'd probably say is I've never seen a commercial area of the law that's so emotion-driven. We've got vendors that either want to get out of the business for some reason, or vendors that are so passionate about their legacy, their employees, their clients, that they're very, very focused on the transaction. And equally, we have purchasers, Matt, that just want to be in yesterday.
Yeah, exactly.
So we often find that we're reverse engineering transactions.
Yeah.
So the first thing I would say to your listeners, both as a vendor and a purchaser, is don't rush.
Yeah.
Don't rush the transaction.
No, exactly. It's going to be one of the bigger transactions you make in your lifetime. So take your time. Understand where the respective parties are coming from, because there's emotion both sides, as Ric has said, and it's important to understand that and respect it, because you step on toes at the start of the transaction.
Yep.
It tends to be very hard to undo that going forward.
So in answer to your specific question now, more is better at the beginning for the lawyers. We need to, vendors often don't, because they're so in the business, they don't appreciate all the things that they may need to disclose as part of the process. And we need to know everything. We need to know about the lease, so that we need to know firstly the tangible documents. Yeah. So you'll have things like plant and equipment lists, you'll have stock lists, you'll have things that are within the business that are tangible and physical. Yep. Then you'll have intangible aspects to the business. So that would include copyright, business names, IP, any technical processes. Then you would probably need to disclose to us the lease and anything related to the lease that's essential to disclose to a purchaser. Employee lists, employee entitlements, that type of information is essential. And then anything that's confidential. And what I'd say about the confidentiality aspect of it, it's important before you disclose anything that's confidential to your business, whether it's your figures or whether it's your processes, that you either have the purchaser on a non-disclosure agreement beforehand, or alternatively have them signed up to the contract before you go disclosing anything. So they're probably the main areas, Matt. Anything else you can?
Yeah, no, I think you've captured it pretty well there, Rick. It's I think one of the big ones is, employee entitlements is a big one that takes some time to gather, to understand, annual leave, long service leave, sick leave, those sort of things. So if you have your ducks in order at the start of it, it certainly makes for a smoother transaction.
Where I mentioned about the accountants and the need to understand or have them involved in the process, often with a vendor, the structures that underpin what we're dealing with are really important for us to understand. Because you may find that assets are located in one structure and the business is located in another structure, and there are capital gains implications or other tax implications that you really need to be across. So I think probably the other thing I'd add is details about the various structures where things might rest.
Absolutely.
Yeah, you make a good point, because even as agents, it's very complex, and as agents, or for viewers really to understand the complexity of what is involved, I think it can be misleading. And as an agent or agencies or agents out there that are dealing with business, it's tough. It's tough, and it's very, very time consuming. I've dealt in some myself. I don't deal with it, a lot, but when you do, you don't realise the amount of work that is involved compared to a standard residential or a land transaction at business, and its emotions, and there's moving parts everywhere. So that's a big part of informing our viewers today what is actually involved, and I think that's a big thing.
And a big one too, Gerald, and you say it's difficult, as agents, because often the vendor, your client, won't understand what they need either as part of the transaction. So, they might never have sold a business before, so they don't appreciate what documents we're going to need and the level of detail that we're going to need about that. And it's also important that, when we're talking business, we can be ranging from, multi-million-dollar transactions to, a corner store selling for 50 grand, something like that. But fundamentally, the requirements are the same. So the amount of work is still the same. So, it's important to get that across.
I don't know about your experience, Matt, but sometimes the multi-million-dollar transactions go smoother than the corner store transactions, unfortunately. So the other thing I would add to what you just said, Gerald, is I think it's really essential for vendors particularly, but both parties, to communicate with their agent. Because of the emotional side, the agent can quite often be in the middle. The lawyers are protecting the interests of the parties. That's right. But if you have open communication with the agent, you can often overcome some of those issues.
Absolutely. Yeah, no, spot on. Matt, tell us about Section 52 and what that is, and what the requirements are for a business owner.
Yep. So Section 52 of the Estate Agents Act, and when we're talking about documents that are important to have at the commencement of the matter, that's probably number one, right up there. Effectively what it is it tells a purchaser about the business. So it requires that it gives your purchaser the financials for the current year, and the previous 2 financial years.
Yep.
Now, if a vendor hasn't been operating the business for that long, then it's got to be for at least as long as they have been operating it for. And it's essentially a profit and loss. It looks at what the business has done over the last couple of years, what the costs of the business are. It looks at what the business hours are, so the days, the trading hours, how long they've been trading for.
Yep.
And it's a requirement because if it's not provided to a purchaser before they sign a contract,
Yep.
it is an open door for a purchaser to pull the pin on the deal at any time prior to settlement. It's also important that the information is accurate, because if it's misleading or false in any material respect, the risk is the same. The purchaser can walk if that's the case. And usually what you'd be telling your vendors at the time they're looking at listing their business is, okay, guys, head off to your accountant now, ask them to put together a Section 52. The accountant will know what that is because both the vendor needs to sign it, the accountant needs to sign it as being correct, and then it will go off to a purchaser as part of the deal. So very, very critical document, because you don't want to do all this hard work, spend the time and spend the money, then realise we haven't done the 52, and a couple of days prior to settlement your purchaser says, you know what, I've got cold feet, you didn't give me a Section 52, I'm off.
Very good. Rick?
I think the only thing I would add to that, putting my litigation hat on, is that even if settlement does proceed, it exposes a vendor to misrepresentation if there is actually incorrect data in there. And we've seen all manner of 52s where they've been handwritten, and you think, well, if you can't spend the money on getting professionals to advise you, you're playing with fire. The only thing, Matt, is prescribed amount, is it 450,000?
Yeah, the figure's 450,000. So a business sold for above that doesn't require one.
Okay.
But a definition of small business currently is 450,000 sale price.
And I think the only other exemption from my recollection is if it requires a liquor licence, you may not need a 52. So if you're selling a restaurant or a...
That's an interesting one. I've had that pop up recently, and I looked at that section, and it has I suppose, a caveat to it that if the business can't be operated with that licence.
Okay.
So I look at things like a restaurant or a cafe that has a liquor licence, but is that, I mean, technically you could operate the business without it. So it's an interesting one. I've sort of formed the view that just do it. What's the downside to a vendor?
I think any prudent purchaser that's being properly represented would require it firstly, and anything over that threshold, you'd want financials anyway. So, I mean, it's just as a matter of course, get it done.
Good. GST, is GST applicable in the sale of business?
Is it ever? Of course, yeah. GST, again, it's one of the big questions to ask at the start of the matter. What we're looking for here, the first question is always whether the vendor is registered or required to be registered for GST. If they're operating the business, very few circumstances would that not be the case, that they weren't registered, but it's possible if the turnover is less than 75,000. Assuming that's the case, we then need to ask, well, is our buyer going to be registered for GST? If the answer to that is yes, we're now moving on to, okay, what are we selling? What is the enterprise that we're selling? And are we selling everything required for the buyer to come in, continue operating the enterprise as if nothing had changed? And if the answer to that is yes, then we're going to be applying the going concern exemption for GST. When we're talking everything necessary, if we're looking at let's pick a cafe or a restaurant. Do they own the building? Do they lease the building? If they lease it, then there's going to have to be a transfer of the lease, or at least entering into a new lease. Employees, stock, all that sort of stuff needs to be part of what we're passing on to our buyer if we're going to tick that box and apply the going concern.
Can there be issues with transferring of a lease during a transaction at all? Does that raise its head
from a GST point of view,
or just in general from the land?
Well, certainly on the GST point, I think Matt's covered that very well. But the only time that you have to give it a fair bit of thought is when you have a party that's buying freehold and a business together.
Yep.
And you want to make sure that you understand what the structures are on the vendor side and what the structures are on the purchaser side to make sure that the going concern provision or the GST provision applies to the right transaction. Probably a bit too complex to go in this forum, but that's, if you're in a situation like that, you really need to take care. Transferring of lease or any discussion around lease matters is one of our biggest focuses. We're wanting to make sure, particularly from a purchaser's point of view, that there is no hidden monsters in the lease.
Yeah.
So there's no dispute with the landlord, or there's no major infrastructures upgrades that are required, that there's a security of tenure for a period so that they know that they've got something just behind them.
Yep.
And if they're not going to stay in that premises, that they've got plans to move, that they've thought about that. From a vendor's point of view, you're really focused on making sure that the guarantor's released, but that's usually pretty par for the course.
It is, yeah.
Anything else you can think of in terms?
I mean, from a vendor's perspective, I think they need to understand that most leases will require that they pay the landlord's legal costs as part of the transfer process.
Okay.
It often gets that they don't realise that. It's a pretty innocuous clause in most leases that you'll find floating around.
Yep.
But it's important that they understand that the landlord's got to give their consent. So what we're really looking for is we've got a contract of sale signed. That contract of sale is subject to our buyer getting a transfer of the existing lease or the granting of a new lease. And then we're approaching our landlord. Vendor is approaching the landlord and saying, okay, I have sold my business. I require your consent as a requirement under the lease.
Yep.
Because from a buyer's perspective, if we don't have that, well, what are they left with?
And look, one other fundamental point, and Matt's last comments jogged my memory. One of the things that often crops up at the last minute is the credit requirements of the landlord of the incoming tenant. They may want to be satisfied that the tenant is a person or a company of means.
Yeah.
And they'll have a list of things that they require. And of course, you get to the week before settlement and you realise that the landlord hasn't been satisfied and everything goes to hell in a handbasket. So you want to be onto that pretty quickly as a vendor, that you've touched base with your landlord and they know that it's coming.
Yep.
Yeah. And often, I mean, I don't know why, but it seems to happen very last minute. And two of the only reasons, if the Retail Leases Act is applying to the lease, which in most cases it will, that the landlord can say no, is if A, they don't think they've got the financial resources to meet the requirements of the lease, or they don't have the necessary business experience to operate a business of that nature.
Yeah.
And that's it. They're the only two reasons a landlord can say no, and they'd need some sort of decent
supporting evidence
to say.
No, that's really good. Really good information. What about during a business transaction or post settlement? You've got restraints and so forth. That plays the important factor, I think, in a transaction. Can you touch on
Sure.
meaning of restraints and how that works?
Well, restraint's probably an area that I've had a fair bit of exposure in the litigation side again. It's obviously often a hot topic. I don't know how many vendors we've seen, Matt, that say, I will never, ever do this work ever again. And then 3 weeks later, they've been offered a job by a competitor and they're in the door again. And you go, oh, what? Anyway, essentially, the general proposition at law is a restraint of trade is void.
Yep.
Unless it's reasonable. So what the clauses we try to put in place in a contract set up that reasonable element. Yep. And what a court will often look at is a number of factors, but primarily it will be the area or the geographical area that you're restraining the party from. It'll be the term or the period in which you're restraining the party from doing what they propose to be doing. And then they look at other factors like the bargaining power, whether the restraint is reasonable in the circumstances. And the number one basis for a restraint being reasonable is if you are selling a business with a customer list and a value of goodwill that you want to preserve. And then if you go around the corner and open up another business, that's where a court will normally step up and say, well, that's not appropriate. Yep. We often put cascading clauses. You may have seen those in a contract, which reduce the area and the time by degree. It might be 150 kilometres and 3 years, 100 kilometres and so forth. The reason we do that is primarily the court has a discretion to read the clause down to a level of what it considers to be reasonable.
Yep.
And you don't want to be in a position where your clause is struck out totally because you haven't got that ability. From a purchaser's point of view, you would be very silly not to consider a restraint, particularly if there are key personnel in the business that you want to make sure stay in the business, and if there is a real heavy reliance on the goodwill aspect of the owner. So if the owner's the reason people deal with that business, you want to be really thinking about restraint. Anything else?
I think it's important to consider who are you restraining.
Yeah.
If the vendor is, say, Ric Sofra Proprietary Limited, and the clause says the vendor is restrained from operating a similar business, etc., 3 years, and you're not restraining Ric Sofra, the individual, you've got yourself a bit of a threshold issue as to who's actually bound and who's not. So that's where we come back to, as Ric was saying, rightfully so, consider who the relevant entities are from the start so that we know when we're drafting documents who are we actually restraining. Yeah.
Well, our standard clauses would normally extend it beyond the company to an individual, and often we'll see in that scenario Matt gave, Ric Sofra might not even be a director of the company that owns the business. So you want to restrain the individual that is tied to the goodwill. So that's a good point.
Yeah, very good. Just some other topics about partners agreements. Within business, how important are they within business, Matt?
They're very important. Unfortunately, you just don't see them very often, Gerald.
No.
You don't. Often what you don't see is the buyer might be a company, and you've got two shareholders, which are mates or family. Even worse, if it's family. And they need to have an agreement between them. A shareholders agreement about very important aspects about the operation of the business. Things like what happens if someone wants out, and what's the process for getting out. What if someone passes away? What happens then? Things like insurance. Do we need what we call a key man policy, where one person passes, which enables the remaining partner to pay out the deceased shareholder, so that the family gets paid their money and they continue on trading with the business. So very important. Unfortunately, I won't speak for Ric, but I don't see them often enough. People form the view that it'll be okay, or they don't want to outlay the cost, which I can understand. The best shareholders agreement is the one you don't have to use. The one that sits in the bottom drawer collecting dust. But at least if you've got one and an issue arises, you've already turned your mind to how that gets resolved. And all the parties have got to do is say, okay, we dealt with this at the start. We now know the footprint that we've got to follow. Here it is. This is how we resolve the dispute. But without it, it's ultimately, Ric will tell you, it's a mess.
Oh, it's a litigation lawyer's dream. People go. It's funny. In my practice, there's only one thing worse than matrimonial disputes. It's partnership disputes. The emotion is illogical. You want to put something in place at a time when everything's calm, when everyone's working together and everything's going well. That's the time to sit down and have discussions about what do we do if things aren't quite so good, because the last thing you want to be doing is trying to untangle a mess when things have gone sour. And there can be there's no podcast long enough to discuss what can go wrong in partnerships. But look, I agree with Matt. You often see them, partnerships that don't have them. The Partnership Act exists, so there is an act which will provide some framework to dissolve these arrangements. But it can be clunky, and you're better off setting up your own structure at the beginning. So I come back to the first point I made. As a purchaser, you would sit down with your accountant, you'd sit down with your lawyer, as a group, if it's a number of partners, if it's family, whatever it may be. You talk about your structure. You talk about what your expectations are, what your hopes are, and what happens if things don't go right. and you put it down on paper. And a shareholders agreement and a partnership agreement, or whatever the variation is not overly complex.
No.
Matt and I will have done hundreds of them, and there's a format.
Yeah.
And there are key questions that we would go through. In every business, there's always an ability to tweak certain things that may be important to you as partners or to your business.
Yep.
But I think you are really playing with fire if you don't spend the money on a partnership agreement or a shareholder agreement.
Excellent advice. So, viewers out there, make sure you duck in and see one of these two guys and get your director or partner agreement in place if you haven't already. So, guys, I might just touch on just employee entitlements through business, who's responsible for that, just for our viewers as well. Matt, did you want to touch on that just briefly?
Yeah, I mean, probably as a general starting point, you're probably looking at most employees transferring across. I mean, that would be the position 90% of the time that I deal with purchases and sales of business. So we're looking at things like, okay, what are their annual leave entitlements? What are their long service leave entitlements? What are their personal leave entitlements? And usually what happens is we have a list of who they are, when they commenced, what their hourly rates are, what the accrued entitlements are, and at settlement there's usually an adjustment.
Yep.
So if the sale price is $400,000 and we've got $50,000 worth of employee entitlements, that's usually a deduction from the price, and settlement's completed, and the purchaser takes over those employees, and those employees' entitlements transfer across as if nothing had changed, as if they'd been employed by the purchaser from day one. I think what a lot of people don't understand is that long service leave is accrued by everyone, including casual. From the day they commence. You know, it's only that you're not actually entitled to take them until you've 10 years of continuous employment, or you leave after 7. Then it's pro rata. So another one that I come across, and Ric will touch on this as well, is what do you do with sick leave? Because if an employee transfers across and then leaves, then they don't get paid out their sick leave. It's not if you leave your employment, you don't get paid out your sick leave. But if the employee transfers across and then, say, within a week becomes unwell, they're entitled to use their accrued leave. So, as far as Fair Work Australia are concerned, their entitlements are no different. Just because the business has changed hands, and they have stayed on in the business, then it's continuous employment, and their entitlements roll over. So,
look, the other few bits that I would add, I suppose, to that. When you're getting the information at the beginning, get whoever it is that assists you with this process, whether it's your accountant or whether it's a bookkeeper or whatever it is, to make sure the data is accurate. Make sure your super's up to date as a vendor, and make sure that you know exactly what those entitlements are, so that you can factor them in. The other thing I would add from a purchaser's perspective, or from both parties' perspective, because there have been transactions where I have been involved in where the management of the process of talking with employees has been sensitive or being mishandled, and that can create a big problem for the parties. So particularly in larger organisations where the key staff are essential, and staff may not know, and vendors may not want them to know, that a deal is being done until such time as there's a contract. You want to make sure that you're talking through your agent, if an agent's involved, but certainly through your lawyers, to manage the process of disclosure, so that when those offers are made by the new purchaser, which have to be on the same terms, that they're made in a way that's going to avoid friction and increase the prospect of a smooth transaction.
And that's important, as Ric said, that usually what will happen is the contract will provide that within a certain period of time prior to settlement, the purchaser will offer employment to the employees on substantially the same terms, and then the employee will either say, "Yep, I'm happy to transfer," or "No, I'm not." For those that say yes, they transfer across on settlement, and there's a allocation deduction from the price for those. Those that say no, then the vendor terminate their employment at settlement, and they pay them out what their accrued entitlements are, and any applicable redundancy if it applies.
it can be one of the more stressful parts of the transaction for both parties, but particularly the vendors. So they need to think about that process. Would be my advice, carefully in how they manage that, because you don't want upset employees, and you don't want people whispering by the water cooler about what's happening.
That's right. And you tend to hear that, and you tend to the cat out of the bag a lot. And that's just probably a bit of human nature, and whether it's just regional or country town,
That's
but
right.
It's a small town. Everyone talks.
If a transaction falls over because you didn't do a Section 52, which of course now that you've heard Matt, you'll definitely do, and then all of the employees know that the vendor's out the door, it can really unsettle the business. So you don't want that to happen.
Yeah. Is there any other topics that you guys want to touch on? Has there been a curly deal that you can enlighten the viewers on that might be,
What I'd say, look, my number one bit of advice to a purchaser is don't kid yourself. Go in with open eyes. Ask the questions that need to be asked, because often you go in thinking it's all positive, I'm going to make this work, and you turn a blind eye to what's obviously there.
Yeah.
So that includes doing, obviously, due diligence on the financials. It includes canvassing what the other, what the key staff might be, understanding the relationships with the main suppliers or the main customers.
Yeah.
To give you an example, whenever I see a franchise agreement, and that's a whole different ballgame, but with franchise agreements, there's an obligation to disclose who the franchisees are and who have left during a period. Yeah. And my advice to somebody that's thinking about joining a franchise is ring the ones that have left, not the ones that are still there, because you want to know what's wrong.
Yep.
So I think make sure that you ask questions of the agents and of your lawyers. Don't think I can fix this. Or make it different. Just be realistic about the prospects of the business. The other thing is, as a purchaser, make sure you got spare cash. Don't go in on an oily rag, because if things don't go the way you want them, you're going to be under serious duress.
Yep. You're going to need a buffer of working capital there.
Yeah.
A big one that I come across quite regularly, Gerald, is understand what you're buying. Because that piece of plant and equipment is sitting there in the premises doesn't necessarily mean the vendor actually owns it.
Yeah.
Particularly, I've used cafes a bit, but it's a fantastic example. Often those coffee machines that you see there are effectively on lease, on the basis that the owner buys their beans and uses other advertising paraphernalia. And if the buyer intends, well, I don't like that bean, I'm going to use a different one, they don't realise that coffee machine will then march out the door the following day. Yeah. And we're talking a big outlay. I love my coffee as much as you two gentlemen, I'm sure. Yeah. And that they're expensive pieces of machinery. So understand what the vendor actually owns, what's on lease, and flowing from that is what PPSR registrations does this vendor have over them that we need to get released prior to settlement. Yep. And do that search. You want to run that search at the start of the matter. It's usually what I do. Run it at the start of the matter, understand what you're dealing with, because sometimes you can have a list of 20, 30 of the things and run it prior to settlement.
That comes back to that point I made at the start, Gerald. Matt and I have been involved in transactions where we've had to reverse engineer the transaction because the parties are so keen that they've already moved in, and the vendor's already left, and you've got PPSR registrations, and you've got cars that need to have roadworthies, and you've got staff entitlements, and we just look at each other and laugh, basically. We go, why? So get all those ducks lined up at the beginning. Don't rush it.
And listen.
And which is why it's important to have that good relationship. As Ric said, there's so many moving parts and people involved. Have that good relationship with your agents, with your accountants, with the solicitors on the other side. Because you're going to strike these deals where you do have to reverse engineer them, and you're going to need the goodwill of everyone, and a good working relationship to get the outcome for everyone. Because at the end of the day, we've got an owner that wants to sell and a buyer that wants in.
I've got to be, we're pretty lucky in the Golden Valley. I think all the lawyers that we deal with are just really a good working relationship with all of them,
Yep.
and that works well. But it doesn't necessarily mean that we don't find ourselves in difficult positions because we've been put there
Absolutely.
by virtue of a transaction.
Yeah.
I mean, there are a raft of different things: stock taking disputes. There's issues over. There are many topics you could discuss. As I said at the beginning,
Definitely.
Gerald, but
No, I think
they're the key.
We've certainly given our viewers and broad audience a great insight. And thank you both to Ric Sofra and Matt Jones for their time and expertise. It's been fantastic, and we look forward to catching up with you guys and continue to work with the business going forward. So,
Thanks for having us.
Thanks again, and look out for this podcast coming up. We'll look out for episode 7, which will also be coming soon, and you can watch us all on your latest podcast platform. So thanks for watching. We'll see you again soon.
Thanks for listening. Please subscribe on your favourite podcast platform so you don't miss upcoming episodes. We would love you to share this podcast with your network, and if you have any questions or feedback, please connect with us via our social network or head to gagliardiscott.com.au.